Hi everyone, it's Chad about another video. Today we're going to be doing a video on AT&T, analysing the company after its spin-off of Warner Brothers. $140 billion market cap company post the Warner Brothers spin-off, up 2% since the start of the year versus a market that's down 20%. Down 30% over the last 5 years is obviously not impressive, losing to the market significantly. That is of course excluding dividends. Obviously made some questionable management decisions in that time, the DirecTV merger, the initial Warner Brothers purchase maybe a bit over 5 years ago, I think that was 2017, very questionable. I want to figure out how it is going forward, what the Warner Brothers spin-off has done for the company, and how its prospects are going forward. Looking at the most recent quarterly presentation from Q1, pretty much the first slide was their business priorities. I'm really impressed by these, of the new AT&T essentially. Grow customer relationships, expand 5G with simplified go-to-market strategy, and expand the fibre. Be efficient and effective in everything that they do. They want to achieve many cost savings, which of course is going to run down that debt number, they hope, and increase free cash flow. Deliver improved customer experience, continue to make net promoter score gains, and maintain low churn across all businesses, which should be the goal of any utility like businesses, to minimise churn as much as possible and expand the business opportunities with fibre and product simplification. And they're making very deliberate capital allocation changes, which is obviously the most important thing. Increasing investment in growth opportunities, particularly 5G and fibre, which they've done for a long time, but they're continuing to commit free cash flow to that. Strengthen the balance sheet with the proceeds from the Warnermedia transaction, which is just absolutely key in what we're really focusing on here. And of course their excess cash generation, and continue to provide that attractive dividend, which they don't really want to cut again after cutting last year. So how is that capital allocation strategy panning out? Well, they've committed $24 billion in CapEx for 2022 and 2023 for growth in 5G and fibre. They continue to plan to reduce debt, targeting net debt to adjusted EBITDA of 2.5 times range by the 2023, which would be a significant reduction, and continue to provide an attractive dividend of around $8 billion a year. This is a company that has very nice free cash flows, so that should be fairly achievable. A summary of the Warnermedia transaction, which closed on April the 8th, they received $40.4 billion in cash and some retention of debt that Warnermedia will essentially take certain debt with it. So it's not all entirely cash, but Warnermedia is effectively taking some debt with it. AT&T shareholders received 71% of Warner Brothers Discovery, improved net debt by $40 billion in April, paid down $10 billion in bank loans, and redeemed or provided notice to redeem an additional $12.5 billion in bonds. Obviously, this is subject to a final adjustment, but this is really, really strong. They need to pay down that debt for this to become a viable investment, really, for the long term. Having such a large debt load, which is well over $100 billion, is a serious impediment to any business, particularly one like this. Current debt maturities, more than 90% of the debt is fixed rate, which is really good and exactly what you want in the high interest rate environment. What will be a high interest rate environment likely going forward. So this is entirely sensible from AT&T and shows decent management and how they've refinanced this debt in the past. The standalone AT&T, so essentially the results minus Warnermedia's impact from Q1, were pretty good. Revenue up 2.5% to down $29.7 billion. This is to be expected going forward. Low single digit percent, maybe 5% in a good year revenue, and this is just absolutely fine by me. Utility like revenue, so I'm completely fine with that. Strong wireless and broadband revenue growth. Adjusted earnings per share up slightly to now $0.63, and cash from operations down slightly, free cash flow down a little bit. Free cash flow of $2.9 billion reflects some seasonality, higher investment, and $1.8 billion from DirecTV. Some increase in capex, which has hurt the cash flow from operations a bit, and some capital investment increases, and some just general some success-based investments that haven't not necessarily panned out. Subscriber gains were pretty good for the quarter, considering the base they're coming off. 691,000 net adds on postpaid phone subscribers. You got to consider this year they have 67.5 million postpaid phone subscribers, so this is some degree of saturation here, but this was a decent acceleration from quarter on 2021, so you have to give them credit for that. AT&T fibre subscribers, 6.3 million, net adds of 289,000, again significant growth from Q1 2021 where they only had 235,000 subscribers. All positive. This will only help revenue in the future. Some balance sheet and profitability metrics here to go through. Obviously, this is still a company that is heavily indebted. Cash debt ratio of 0.7, over $100 billion in debt at the minute. Debt to equity of 1.36. Nothing particularly impressive here, but management are taking the correct steps to correct this. AT&T is going to have a significant debt load for many, many years to come. That is something, if you're going to invest in this company, that you're just going to have to get used to. They make significant cash flow from operations, and they pay a healthy dividend to do in the meantime. But this is going to be a weight on AT&T's back for a very, very long period. They have decent interest coverage at 3.89, meaning with the current EBITDA, they could pay off their interest for 3.89 years, which is decent. They have an Altman score of 0.77, which indicates this company that is at risk of financial distress. But as we saw earlier, a lot of this debt is fixed rate, 90%. So that is not so worrying as the interest rate environment continues to rise. From a profitability standpoint, gross margin 53%, not super impressive for this industry, but pretty good if you ask me. 53% gross margin is absolutely excellent. 16% operating margin, pretty good for the industry. Net margin of 10.64, meaning they take home $10.64 cents for every dollar in revenue. Pretty impressive for a company of this scale. Return on equity of 10%, not overly impressive, kind of in the mid-range of where I'd expect, between 5 and 20%. Return on assets is a very asset-heavy business, so 3% is kind of to be expected when it's such an asset-heavy business. A return on invested capital of 4%, which is not overly impressive, but pretty decent for a company of this scale and maturity. Really, the most obvious investment case for this company is that it's just so cheap. I mean, a P ratio of 8 is obviously very good for the industry, very good for anything right now. Forward P ratio of 7, very, very cheap. Price to free cash flow of 6.87 is like staggeringly cheap. There's not many companies you see that low. Price to operating cash flow under 4, which is ridiculous, and is both far below the S&P 500 average, which I believe is around 18 at the minute, considering how fast the market's fallen. These are exceptionally low values, really, and AT&T kind of always trades in this ballpark of between 8 and 15, so they're not ridiculous numbers for AT&T's history, but they're certainly at the lower end. And you've got to bear in mind, this is a company that was struggling for a long time with mismanagement and increasing that debt load, and some horrible acquisitions, some of the worst acquisitions in history, being the Time Warner acquisition and DirecTV acquisition. This is really now a management team that is settled and is making the right decisions. So I think in the long run, these Ps will look very, very cheap. A more advanced valuation metric is, of course, the discount cash flow analysis. AT&T makes very consistent free cash flow numbers, and they've done so for the last 10 years with a free cash flow yield 4.3% on average, which is pretty good. I don't believe they can keep this going forward. That was perhaps aided by the Warner Brothers segment, which is a clear growth engine for this company. Taking a conservative view, saying that they're going to grow at 2% for forever, essentially, terminal stage and growth stage. That gives us a fair value with a 10% discount rate for the long-term returns of the stock market in a higher interest rate environment. This gives us a fair valuation of $28.23 compared to a present-day stock price of $19.55. Now, whether or not you think they can continue to grow with free cash flow at 2% is up for debate, of course. This is my prediction. I think this is a relatively conservative estimate. Then the revenues are going to go at 2% every year. They have decent pricing power, being in the situation they are. It's effectively a utility. It's a big hassle to change your fibre provider or your phone provider or something like that. I think AT&T is well positioned to make low single-digit free cash flow yield for the long term. Of course, it's very hard to be drawn into making short-term stock predictions right now, considering how just all over the place the market is. AT&T done very little this year because it's a safe company, it's a dividend haven, pays a near 6% dividend yield, even though that's been cut recently. It's got horrendous debt, but it's managing its balance sheet well. It seems like it's on the turnaround, and it is essentially a utility. I can see its revenue growing 2 to 3, maybe 5% forever. Essentially, I think it's significantly undervalued on a free cash flow DCF basis. I think there's definitely some opportunity to be had here. Of course, you would have to take a dollar cost averaging approach, because who knows what the stock market is going to do today, tomorrow, and maybe AT&T is going to drop further because of a wider market crash. But of course, you look at the price to earnings, this is exactly the type of company that people will flock to, those environments. As I said, a lot of its debt is fixed rate, so it won't be affected by interest rates, so they can get away with that essentially, and their debt position looks a lot worse than it actually is. I believe this is a thoroughly decent time to invest in AT&T and make it as part of a balanced portfolio with some growth names in it. AT&T is a better off company that'll pay 5 to 6% dividend for the long term. I think they'll continue to keep up this dividend. It seems fairly safe with the amount of free cash flow they generate. But of course, this is just my opinion, and you shouldn't take this as financial advice. Of course, you should do your own research and due diligence, not just listen to me, because some of my stock picks have been horrendous recently. If you're enjoying the videos, please like and subscribe and help the channel grow, and I'll see you again next time.